was able to save us from the coronavirus abyss, give us one of the most strong rallies of all time, bring us to new all-time highs, if not the strongest rally of all time. And we've seen them pivot. And their pivot correlated with the second worst start of all time in history. So clearly, we don't want to fight the Fed. However, today that's happening. I think the market is fighting the Fed, and I'm going to tell you why I think that's happening. The Fed is surprising us with hawkish guidance. We had the meeting last week. Oh, no guidance? Bullish, let's go. You know, we're going to be data dependent, et cetera, et cetera, et cetera. Interpreted as dovish by the market. We built on that momentum. Here we are. However, since then, we've had basically every Fed member that speak say we need yields higher for longer. We are concerned about inflation. We're not convinced. And the market had been positioning as if, oh, we're going to see peak inflation and boom, then we can drop rates because there's a recession. That paradigm is not true, okay? The market is wrong about that. Anyone who tells you that is not being intellectually honest with what the Fed themselves is saying. And at this point, the Fed is not lying to us. They're adjusting, but they're not lying to us. So, I mean, maybe they did with not doing 75 basis points, but if anything, that should show you they're getting more hawkish. So, I'm not going to assume the Fed is lying to us here. I think the Fed is being honest. I think they're going to stay tight. And the market is assuming that they're going to drop rates and they're going to turn dovish when they need to turn dovish. Bullard said, you know, we're not going to turn dovish just on a few ticks below in inflation. They want to see inflation several consecutive months down to 2%. They want to get close to 2%. Loretta Mester said she's not convinced inflation is, she's seeing no signs of inflation peaking. I mean, it's obvious WTI has pulled back a little bit, commodities have pulled back a little bit, but they're still saying, they know that, they see that. They're not dumb, they're not pretending they don't see the facts, and yet they're still saying inflation hasn't peaked. So we have to assume a hawkish Fed here, right? We have to assume 3.5 to 4% rates by year end. Maybe they only get to 3.5 because that seems to be Bullard, the more hawkish end, 3.5 to 4. People at the more dovish end, 3 to 3.5. Sounds like they're going to settle together on 3.5 unless inflation gets super hot or something, and maybe in the opposite direction they go to 3%. Bottom line, 10-year 2.7. So unless you think there's going to be a serious inversion of the Fed funds and the 10-year, you should assume the 10-year is going to be higher. That can happen, but that can happen in severe recessionary environments. I don't think anymore that we're in a severe recession. I think we're in a technical recession. Yes, technically we are in a recession, 2 consecutive quarters of GDP. Screw everyone who's saying it's not a technical recession. It is a technical recession. That's the definition. That's what I learned in school. But I guess you can have a recession and it not be a big deal to everyday lives. The economy's just changing, I guess, in some magical, mysterious way. So, companies are beating earnings. It's not a crazy environment. People aren't getting hurt by this recession. Unemployment isn't down. Companies are strong. It's not like we all have to flee to bonds. So, since not everyone needs to flee to bonds, I don't think the 10-year is going to invert below the Fed funds rate. I think the 10-year is going to be above the Fed funds rate. That's where it should be. The Fed is tightening more hawkishly. Don't fight the Fed, ever. And don't fight the Fed. That's it. I see, you know, people are just, whatever. I'm taking advantage of the situation. And I'm not afraid to go short bonds, i.e. assuming rates go up in longer duration positions, things that are going to bring me closer to the end of the year. Stock positions, TBT, ETF. I used to just have options as a hedge. That's what I had yesterday. Probably won't add to this position beyond today because it's quite big now with the position in the options. I had this position earlier in the year. I have the position again now in the stock. It made tremendous gains earlier in the year. And now I have some TBT. We talked a little bit about that yesterday in yesterday's video. Yesterday's video is probably 0.2% weighting in my portfolio, all stock and options. I just had options yesterday, exposure to TBT. Now it's closer to like 6% exposure to TBT after today, after this pullback again into the red, after being in the green this morning. Why was it in the red? It was Kashkari who said inflation was going to be transitory. I don't know why people took this comment and this group of comments as dovish. Maybe it's summer. Maybe people are on vacation, which is understandable. We all have lives to live. We all need a break. We can't be doing this 24/7. But he's not saying he sees inflation ending now. He's not saying he's seeing peak inflation. Okay, that would fly right in the face of what he was saying all weekend. That was not what he was saying. I actually interpreted this as hawkish. He was saying inflation might end up being transitory. You know why? Because we're going to do everything we can to make sure it gets down to 2%. We know it's not there now. It's not there now. Okay, get it? Get this. Inflation is not down. We just had peak inflation. But we're going to go hard to bring this inflation down. And he brought up a new idea that hadn't been brought up in the past. And guess what? This is a very hawkish thing too. He said U.S. banks need higher capital requirements, essentially. He said they need more capital. They need more cash on hand. That is a tightening policy. When banks have to keep more money in reserves, and let's remember, the Fed can raise the reserve requirement. Oh, Walmart lays off hundreds of corporate workers. Interesting headline, nonetheless. Staying on point here. The Fed can control the reserve requirement, which it sounds like they're starting to hint at. Another hawkish policy, in addition to quantitative tightening, selling the bonds on the balance sheet, in addition to raising the interest rates, they can increase the reserve requirement. So banks can't lend. Less money supply, less circulation. They're going full tight. They're going full hawk. Heed this warning. Heed this message. They're going hawk, okay? I don't know why yields are down today. I have no idea. We'll see what happens. That's today's video. And until next time, peace out.